Before we jump in, I do earn a referral fee when you use the services and companies I demonstrate in the video, but there is no additional cost to you. I chose them because they're the best in the industry and you're safe with them.
Welcome to another engaging discussion on corporate structures for your small business. As we embark on this journey, it's crucial to understand what corporations are. Simply put, a corporation is a legal entity created by individuals, stockholders, or shareholders with the purpose of conducting business. This structure separates the company's assets from its owners, providing a layer of protection against personal liability. It's like a separate person, with its own rights and responsibilities, distinct from those who established it. Corporations play an integral role in the business world, offering advantages such as limited liability, easy transfer of ownership, perpetual existence, and potential tax benefits. But not all corporations are created equal. There are different types, each with its unique characteristics, benefits, and drawbacks. In the context of small businesses, two types of corporations often stand out: S corporations and C corporations. Now that you have a basic understanding of what a corporation is, let's delve into the specifics of S Corp and C Corp. Today we're focusing on two types of corporate structures: S corporations and C corporations. These are common choices for small businesses and are named after the subchapters of the tax code they fall under. But what are they exactly, and how do they differ? Let's start with the C corporation. This is the most common type of corporation in the United States. It's a separate legal entity created by a business owner or group of business owners who then become shareholders. One of the key characteristics of a C corporation is that it pays its own taxes. It's subject to what's known as double taxation. This means the corporation pays taxes on its income, and then shareholders also pay taxes on dividends they receive. On the other hand, we have the S corporation. The S corporation is a unique entity that skirts the double taxation issue. Instead of the corporation itself paying taxes, the income or losses are passed directly to the shareholders. They then report this on their personal tax returns. Essentially, S corporations allow for what's known as pass-through taxation. So, if both are corporations, what sets them apart? Well, there are a few key differences. First, the S corporation has a limit on the number of shareholders it can have, which is currently set at 100. On top of that, all shareholders must be U.S. citizens or residents. C corporations have no such restrictions. Secondly, S corporations can only issue one class of stock, while C corporations can issue multiple classes. This gives C corporations more flexibility when it comes to raising capital. Lastly, the tax structures of these corporations are fundamentally different. As mentioned earlier, C corporations face double taxation, while S corporations offer pass-through taxation. Understanding these differences is crucial in determining the best structure for your small business. In the next scenes, we'll delve into the advantages of each, helping you make an informed decision on which corporate structure is right for your business. Now, let's look at some of the advantages of choosing an S corporation for your small business. An S corporation, or S Corp, offers many benefits that can be attractive to small business owners. One of the most notable of these is pass-through taxation. This means that the corporation itself isn't subject to federal taxes. Instead, the company's profits or losses are passed through to the shareholders, who then report this income or loss on their personal tax returns. This allows you to avoid the double taxation that can occur with other types of corporations, where both the corporation and the shareholders are taxed. Another advantage of an S Corp is the provision of limited liability. This means that as a shareholder, your personal assets are protected. If the corporation incurs debt or faces a lawsuit, your personal assets, such as your home or personal savings, are not at risk. This is a significant advantage for small business owners, providing a safety net that allows you to take calculated business risks without fearing personal financial ruin. S Corp also offer the advantage of easy transfer of ownership, without triggering any adverse tax consequences. This can be particularly beneficial in situations where a shareholder wishes to exit the business or if the business is sold. The ability to easily transfer shares can make the business more attractive to potential investors, increasing its marketability and value. An additional benefit is the ability to attract investment. As an S Corp, you can issue both voting and non-voting stock, allowing you to raise capital while retaining control over your company's decisions. But it's not all about the money. S Corp also allow for a more formal business structure with directors and officers, which can add credibility in the business world. An S corporation can be a great choice for many small businesses, but it's not the only option out there. It's important to weigh these advantages against your specific business needs and objectives. A smart business move is always an informed one, so stay tuned as we continue to delve into the world of corporations. Let's not forget about C corporations. They come with their own set of advantages. C corporations are a staple in the business world, and for good reason. They offer a number of benefits that can help your business grow and thrive. One of the most prominent advantages is the ability to have unlimited shareholders. This means your business can attract a large number of investors, which can be a significant advantage when it comes to raising capital. Now, you might be thinking, but wait, doesn't that mean I'll have to share my profits with all these shareholders? Yes, but that's where another advantage of C corporations comes into play: the potential for lower tax rates. Unlike sole proprietorships and partnerships, C corporations are taxed at the corporate level. This means they may be subject to lower tax rates, which can leave more profits in your pocket, even after sharing with shareholders. Another key advantage of C corporations is the ease of raising capital. With the ability to sell stocks and bonds, C corporations have more avenues to raise funds than other business structures. This can be crucial when it comes to expanding your business or investing in new projects. Moreover, C corporations offer a level of prestige. Many of the world's largest and most successful companies are C corporations. Operating as a C corporation can lend your business a sense of credibility, which can be beneficial in attracting customers, partners, and investors. But perhaps one of the most appealing aspects of C corporations is the separation of personal and business liabilities. This means that as an owner, your personal assets are protected in the event of any business debts or legal issues. Now, it's important to remember that every business is unique, and what works for one may not work for another. But with these advantages in mind, it's clear to see why C corporations are a popular choice for many businesses. Just like an S corporation, a C corporation can be a viable option for your small business, depending on your specific needs and goals. So, you might be wondering, should I choose an S corporation or a C corporation for my small business? Well, the answer isn't always black and white. It boils down to several factors, each as unique as your business itself. Let's dive into some of these considerations to help you make an informed decision. First off, consider the size of your business. If you're a smaller operation, say of 100 shareholders or less, an S corporation could be a good fit. It allows for pass-through taxation, which means the company's income, losses, deductions, and credits are passed through to shareholders for federal tax purposes. This eliminates the double taxation often seen with C corporations. However, if you're planning to scale your business significantly, or if you're shooting for that next big IPO, a C corporation might be more your speed. It allows for unlimited shareholders and different classes of stock, making it a desirable choice for businesses with big growth aspirations. How you want your business to be taxed is another crucial factor. As mentioned, S corporations offer pass-through taxation, which can be beneficial for smaller businesses. On the other hand, C corporations are subject to double taxation, once at the corporate level and again on shareholder dividends. But C corporations can retain earnings and have greater flexibility when it comes to income shifting. Lastly, think about your business's future. Do you see it remaining privately owned, or do you have dreams of going public one day? S corporations are limited to one class of stock and cannot be publicly traded, while C corporations have no such restrictions. Remember, there's no one-size-fits-all answer. It's about weighing the pros and cons and understanding how each type of corporation aligns with your business's goals and growth potential. Consulting with a tax professional or business advisor can provide additional insight tailored to your specific situation. In the end, the choice between an S corporation and a C corporation comes down to what's best for your small business. Choosing a corporate structure for your small business is a significant decision. We've journeyed through the intricacies of S corporations and C corporations, delving into their unique qualities and potential advantages. We've seen that S corporations can offer tax benefits and allow income and losses to flow directly to the owner's personal tax return, while C corporations, on the other hand, offer the perk of no shareholder limit and the potential for easier capital accumulation. But remember, there's no one-size-fits-all answer. The best choice depends on your individual business circumstances, your future plans, and your personal financial situation. It's vital to consult with a knowledgeable attorney or accountant who can help you weigh the pros and cons based on your specific needs. Remember, the choice between an S corporation and a C corporation is a strategic one that can impact your small business in many ways. Thanks for joining us today, and we look forward to helping you navigate your business journey.